Why trading support and resistance zones will make you poor. Most traders cling to support and resistance zones because they look visually appealing, clean, neat lines that make sense to the untrained eye. It feels logical, right? The price touches a line and bounces back like magic. But here's the cold truth. Price movement is not dictated by pretty patterns or lines on a chart. The market is a chaotic battlefield where market makers reign supreme, and their primary goal is to fill orders and hunt liquidity, your liquidity. The flashy bounce you're hoping for, that's often a trap. Welcome to the reality of stop hunting, a tactic used by big players to liquidate retail traders before the real move happens. What is stop hunting? Stop hunting is the intentional movement of price to trigger stop-loss orders placed around obvious support or resistance levels. Why? Because those stops are pools of liquidity that fuel the market. Think of stop losses as the gasoline needed for market makers to ignite price movement. Here's how it works. Long traders place stop-loss orders below support zones. Short traders place stop-loss orders above resistance zones. The mechanism behind stop hunts. When stops for longs or shorts are triggered, this creates either forced selling or forced buying. For example, long stop losses, triggered stops create sell orders, driving the price lower temporarily. Short stop losses, triggered stops force shorts to buy back their positions, creating bullish momentum. This mechanism generates large moves in the opposite direction, often wiping out retail traders who entered prematurely. When price dips below support or spikes above resistance, those stops are hit. Longs are liquidated, and shorts are forced to cover, creating momentum in the opposite direction. This manipulation provides market makers with the liquidity they need to execute their larger orders. What does that mean for you? The bounce you're expecting is more likely to be a squeeze, followed by the real move. The sad reality? Most retail traders are on the wrong side of it. How to trade stop hunts. Like if you don't want to end up as a liquidity for someone else's trade, here's how you can turn the tables. It is advisable to focus on one setup. For me, this turned out to be the best and most effective. With its help, I have already gone through more than one funded account, discounts for which you can find in the description of this video or on my website. Accumulation, manipulation, distribution. I've covered this setup in detail on my channel, but here's the gist. Understand accumulation and distribution. On larger timeframes, you'll see clear patterns where smart money accumulates or distributes positions. If you're trading long, look for price to accumulate, drop to sweep liquidity, and then reverse from a zone of interest like an imbalance. It works on any time frame, but higher time frames yield stronger moves. This gives you the best entry, tight risk, and massive reward potential. Stop hunting isn't a dirty trick. It's the fuel of the market. Learn to trade with it, not against it. Be patient, be smart, and trade with a narrative, not just patterns. If you want to develop your own strategy, use my free website and get exclusive discounts on funded accounts. Good luck and don't gamble.